This strategy is perfect for beginners and it's something I personally use in my own portfolio. I'm talking about the 3-fund portfolio, a diversified low-cost way to invest that you can literally set up and forget. Whether you're just starting out or have been investing for a while, this strategy can work for you. In this video, I'll explain how it works, show you how to set it up, and even share some real-life examples, so let's jump in. So what exactly is a 3-fund portfolio? It's a strategy that breaks down your investment into 3 simple areas: US stocks, international stocks, and bonds. Now you might be wondering why these 3. By having exposure to the entire stock markets both in the US and internationally along with bonds, you reduce the risk while still having the potential for strong returns. It's an all-in-one solution that doesn't require you to pick individual stocks, follow the market daily, or stress about market volatility. The key to a successful investment portfolio is understanding that diversification helps minimize risk. Think of it this way: if one stock or sector takes a dive, your portfolio is still likely to stay intact because you're not putting all your eggs in one basket. Instead of worrying about the performance of one company or markets, you're invested in entire markets, US stocks, international stocks, and bonds, which naturally balance out risk. For beginners, this is especially useful because individual stocks is tough and even professional money managers can't beat the market consistently. The 3-fund portfolio makes it easy to get broad market exposure without any of the guesswork. You don't have to worry about picking the right stock, timing the market, or obsessing over your portfolio every day. The biggest advantage here is simplicity. The 3-fund portfolio is hands-off, making it ideal for anyone who doesn't want to be glued to the computer, screen tracking individual stock prices. You can set it up, make monthly contributions, and let the magic of compound growth work for you. Over time, this strategy has proven to work for many long-term investors. Alright, now let's talk about how it actually works. The 3-fund portfolio consists of just 3 funds: a US total stock market fund, an international stock market fund, and a bond fund. The idea is to split your investments into these 3 funds based on your risk tolerance and goals. Most people allocate a higher percentage to stocks, both US and international, when they are young and more time is on their side, and then gradually increase the bond allocation as they get older to reduce volatility. But the question is, how do you decide what percentage goes into each fund? That's where your personal preferences and goals come into play. Some investors may be more risk averse and prefer a higher percentage of bonds. Others may be okay with more volatility, knowing they have time to recover in case of market downturns. For example, I personally allocate 60% to US stocks, 30% to international stocks, and 10% to bonds. But this can vary depending on your age, goals, and risk tolerance. If you're younger, say in your 20s or 30s, you have a long time horizon, meaning you can afford to take more risk with stocks. If you're in your 40s or 50s, you may want to shift towards a more balanced approach with a heavier bond allocation to preserve your gains. It's important to understand that your asset allocation will evolve as you age and as your financial situation changes. Building your own 3-fund portfolio is really easy. First, you need to choose your funds. Let's go through the best options. US stocks, you can go with an ETF like VTI or a similar one like ITOT from iShares. This gives you exposure to the entire US stock markets, including large, mid, and small cap stocks. For international exposure, try an ETF like VIXIS or IXUS. This gives you exposure to developed and emerging markets around the world, including Europe, Asia, and Latin America. For bonds, a good option here is BND or AGG. These funds give you a broad range of government and corporate bonds, providing you with a fixed income portion in your portfolio to balance out the risk from the stock portions. Now, once you've picked your funds, it's time to decide how much to allocate on each one. You don't need to be exact, but it's important to stick with a plan and adjust over time. Think of your initial allocation as a guideline, and as your life situation changes, you can tweak the numbers. This is where things get personalized. Your allocation will depend on a couple of factors. Number 1 is risk tolerance. How much risk are you willing to take? If you're comfortable with the ups and downs of the markets, you'll probably want a higher percentage in stocks. If you're more risk averse, you'll want more bonds. Number 2 is age. The younger you are, the more you can afford to invest in stocks because you have time to ride out market downturns. The older you are, the more you might want to allocate towards bonds to protect your portfolio from volatility. For example, a 20-year investor might have 90% in stocks, 10% in bonds. As they get older, maybe by the time they reach their 40s, they could adjust to a 70-30 or 60-40 split between stocks and bonds. A 60-year-old investor nearing retirement may prefer a 40-60 or even 30-70 split, focusing more on bonds to preserve capital. Let's take a quick look at how this portfolio has performed over time. Since 2000, the US stock market has averaged about 7 to 9% return annually, depending on the time frame you use. The bond market generally returns around 2 to 3%, but that can vary based on interest rates. Over time, the 3-fund portfolio has delivered solid returns while minimizing volatility. In the last decade, despite market downturns like the 2020 crash, the 3-fund portfolio has shown consistent growth. While individual stock picks can be volatile, this strategy provides a smoother, more predictable path to long-term wealth accumulation. One of the biggest advantages of the 3-fund portfolio is its low cost. All the funds are passively managed, meaning they track the market, and their expense ratios are super low, usually between 0.05% and 0.1%. That's $5 to $10 per year for every $10,000 you invest. In comparison, actively managed funds like those run by famous managers can have fees as high as 1% or more. Over time, those fees can eat your returns, which is why passive investing with low-cost ETFs is such a smart choice. A small fee difference might not seem like much at first, but over 20 or 30 years, that small fee could end up costing you tens of thousands of dollars in lost potential returns. Lower fees mean more of your money is working for you instead of going to the pockets of fund managers. As time goes on, your portfolio will naturally get out of balance. Maybe the US stock market has done really well and now your US US stocks makes up 70% of your portfolio, while bonds are only at 5%. To keep your original allocation intact, you'll need to rebalance. Rebalancing is the process of adjusting your portfolio back to your desired asset allocation. If stocks have outperformed, you'll sell some of them to buy more of your bonds and international stocks. The goal is to keep your allocation aligned with your risk tolerance and investment goals. Rebalancing can be done by either selling some of your overperforming assets like US stocks and buying more of your underperforming assets like bonds, or by just adding new money to the underweight areas. Some platforms like Vanguard and One Finance will even do this automatically for you, making it even easier to stay on track. One of the keys to success with the 3-fund portfolio is consistency. It's easy to get distracted by market noise, but the best thing you can do is stick with your strategy. Keep contributing regularly, whether that's monthly or quarterly, and let the magic of compound growth work its way into your future. Remember, this isn't a get-rich-quick strategy. It's about steady long-term growth. Stick with this, stay disciplined, and you will see the results in the long run. Now that you know how to build and manage your 3-fund portfolio, it's time to take action. Start by picking your funds, setting your allocation, and making your first investment. With that being said, if you found this video helpful, make sure to hit the like button and subscribe for more content like this. Also, let me know in the comments if you're already using the 3-fund portfolio or you are planning to start. Thanks for watching, and I will see you in the next video.